Ever wonder why your savings account might suddenly be earning more, or perhaps less, interest? It often has to do with a seemingly obscure term you might hear on the news, the federal funds rate. But what exactly is this rate, and how does it trickle down to impact the interest you earn on your savings, especially with online banks like BrioDirect? For many, the world of central banking and monetary policy feels distant and complex. Yet, the decisions made by the Federal Reserve, specifically regarding the federal funds rate, have a surprisingly direct and tangible effect on your personal finances. Think of it as the bedrock interest rate in the U.S. economy. It's the rate at which banks lend their excess reserves to each other overnight to meet their mandatory reserve requirements. While you, as an individual, don't directly borrow or lend at this rate, it sets a fundamental benchmark for borrowing costs across the entire financial system. So, how does this invisible hand reach into your BrioDirect account? When the Federal Reserve raises the federal funds rate, it signals a tightening of monetary policy. This means it becomes more expensive for banks to borrow money from each other. To compensate for these higher borrowing costs and to attract more deposits to fund their own lending activities, banks often respond by increasing the interest rates they offer on savings accounts, including high-yield savings accounts like those offered by BrioDirect. Conversely, when the Fed lowers the federal funds rate, it makes borrowing cheaper for banks, which can lead them to reduce the interest rates they offer to depositors. BrioDirect, as an online-only bank, operates with lower overhead costs compared to traditional brick-and-mortar institutions. This leaner operational model allows them to pass on more competitive interest rates to their customers. However, even with this advantage, BrioDirect's rates are not immune to the gravitational pull of the federal funds rate. They, like other financial institutions, closely monitor this benchmark. When the Fed adjusts its target rate, BrioDirect will inevitably review its own offerings to remain competitive in the market while also managing its own profitability. It's a delicate balance. If BrioDirect offers rates too low, they risk losing customers to other online banks vying for deposits. If their rates are too high, it might cut into their profit margins, especially if the cost of borrowing for them increases due to Fed actions. Therefore, while BrioDirect aims to provide some of the best rates in the market, those rates will always be influenced by the broader economic landscape, with the federal funds rate at its core. It's the primary lever the Fed uses to manage inflation and economic growth, and its ripple effect touches everything from mortgage rates to, yes, even your high-yield savings account. Understanding this connection empowers you to be a more informed saver. By keeping an eye on Federal Reserve announcements and understanding the implications of changes to the federal funds rate, you can anticipate shifts in savings rates and make more strategic decisions about where to keep your money. With that said, thanks for watching, and until next time.